So the basic idea is, if you think about profits for an individual firm, you understand that, okay, if my sales are more than my costs, I'm making a profit. But for the macro economy as a whole, the economy as a whole is a closed system. Let's take the world economy, or let's take a closed economy. Then it's a closed system. One firm's revenue is another firm's cost in some form or the other. So if, let's say, you are the business sector and I am the household sector, and you pay me wages, and I spend all that back, you only break even. You don't make any profits. So where do profits come from in the aggregate? And when you think about it, what happens is somebody has to be expanding their balance sheet. So they make a balance sheet transaction. For them, it's a balance sheet entry, not an income statement entry. But for the other people, it's a revenue. So even within the corporate sector, when one firm invests in capital, it's capital spending, it's a balance sheet entry. But for the firm making the capital goods and selling them, it's revenue and profits. And same with household sector. When I go and borrow and buy a house, it's revenue for you. That's how profits get generated. The key thing is the investment and somebody expanding balance sheets.
And this overlaps with a lot of the dynamics that we're currently hearing about in the market, right? So modern monetary theory, for example, is an example of one segment, or actually two segments of the market expanding their balance sheets, the banking system and the government sector. But at the heart of it sits this Kalecki equation, this idea, or the Levy equation, to more properly allocate it. It's this idea that somebody's investment is another firm's revenue/profits.
Correct. Right? Absolutely.
Are there constraints, or how do you think about that in terms of providing a forecast? Because to a certain extent, it's just an accounting identity.
That's right. So when you think about the forecasting, it is an identity. But when you think about the real world, you will see that profits are a residual, right? Businesses make a lot of the decisions, like investment or hiring, and people and other counterparties like households, they're making their saving decisions and spending decisions. At the end of it, the profit is really the residual. So in a short-term sense, you can try to forecast profits from trying to forecast the other items. In a long-term sense, of course, it's an identity, but what it tells you is the constraints on what's going to happen. For example, let me just give you an example. When somebody says that, okay, we need to do austerity, what it's telling you is, okay, the government is going to try and reduce its deficit. So if you're still going to have profits, the identity is telling you that somebody else must be running a deficit. Somebody else must do the job of expanding their balance sheet if the government is going to try and shrink its balance sheet. And who is going to do that? And what are the constraints on their expanding the balance sheet? And that's what tells you why something like expansionary austerity is possible or not possible.
So when we think about that in the context of the last business cycle, right? We saw the government attempt to run austerity, particularly in the late era of the Clinton administration. We actually began running surpluses within the United States. And that manifested itself in the expansion of the private sector balance sheet. In 1999, it was the corporate sector that expanded its balance sheet. And between 2003 and 2007, it was the household sector through mortgage borrowing. Who's expanding their balance sheet now?
Right now, that's why the problem is the government is expanding the balance sheet. That's why in the United States, you see large deficits. The countries which are trying to constrain their deficits, like in Europe, you see the economy sagging. Because the private sector is still burdened with heavy leverage in Europe. I mean, people tell you they have deleveraged, but in reality, if you look at overall private sector leverage scale to GDP, it has just barely come down. I mean, it's at the same level. Now, lower interest has made it more manageable, but that doesn't mean that you're going to be able to re-leverage from these levels.
When I think about this dynamic, right, and the fact that the government sector is expanding its balance sheet, that's true in the United States, where we're running large deficits. It is true to a certain extent in Japan, although a little bit less so. There's been an attempt to reduce that, at least in official data in China. And as you mentioned, Europe has largely tried to run austerity. With the US continuing to run expansion and that expansion continuing to grow, does that create the conditions that allow the household and corporate sector to delever, in your opinion?
Yes, and in the United States, there has been some deleveraging going on in the household sector, right? From the peak household debt to income ratio, it has come down significantly by about 20 percentage points at the peak in 2008 to where it is right now. So that's clearly been facilitated by the government running large deficits. Now, in the corporate sector, we have again re-leveraged. The problem is in the corporate sector, there is a huge distribution issue between profits going to some segment of the firms, whereas the ones that are expanding are not necessarily creating huge amount of cash flow. So you have seen the leverage increase.
So one of the dynamics as we talk about the corporate sector is this issue of concentrated wealth or concentrated income in some sectors. Technology would be a good example of that. And many sectors that are much more stressed. I mean, the corporate credit markets, for example, show higher levels of leverage and reduced debt serviceability relative to prior cycles.
Right.
When you think about it in the aggregate, which is what a Kalecki type equation does, how do you account for the fragility that is created by that type of dispersion?
Right, that's a tough thing because in the aggregate is not going to tell you that kind of fragility that arises. So you have to disaggregate and look at it. So that's why cross-country comparisons of debt-to-income ratios are often not informative. For instance, if you look at many countries have much higher debt-to-income levels than the United States. Australia as an example, right? Netherlands. But they have carried this on for a much longer time. So partly because the debt is much more evenly distributed, income is much more evenly distributed. So the debt service, there are not as many stressed households. So the same with the corporate sector. So what you have to really look at, you have to look at it disaggregated. So we do look at the CompuStat data by listed companies at least, see where the disaggregated debt service ratios and the profits are.
Does that introduce the second topic that you were talking about, the constraints, the limitations? I mean, do you think about it in a discontinuous fashion that if things push too far? Yeah,
that's the Minsky thing, right? I mean, that's why Minsky came up with this schema of hedge, speculative, and Ponzi finance, right? So he looked at the corporate sector, and basically he was thinking more about the corporate sector. At the time, household leverage was not a big deal. So his thing was when balance sheet structures are very solid and robust, most of the firms are what he called hedge. That is basically they have enough cash flows to make debt service comfortably. The speculative firms are those who have enough cash flows to make the interest payments, but just about. And the Ponzi is people who need financing even to make their interest payments, right?
So if you disaggregate it into those three buckets,
right,
and we think about, so a company like GE, for example, I would argue falls into the speculative camp, right? Where they are, to a certain extent, as we've just seen, asset rich with the sale of one of their business divisions that significantly reduces their debt load. But if credit markets were to close, they would not have the capability of refinancing a significant debt load.
Right, exactly.
Apple would be the other extreme in terms of a hedge ratio where they probably had an underrepresentation of debt in their capital structure. We've seen them increase that.
Right.
When you look at the third sector, the Ponzi component, is there a problem there? Is that grown relative to other aspects of the economy, or is that also somewhat under control?
Well, it has grown. If you look at it from a secular sense as well as a cyclical sense, you see the number of firms with negative profits. Of course, there's biotech in there, so there is some element of that. But still, it has cyclically grown. But on a secular basis, if you look at it, the number of firms with negative profits that manage to survive, and people call them zombie, I wouldn't necessarily call them zombie, but manage to survive, has actually gone up over the last 30 years. That is the secular worsening of balance sheet structures in some ways. But also it tells you about the credit markets that, 40 years ago, there was no such thing called junk, right? I mean, there was a junk bond market was essentially fallen angels. But the proliferation and the broadening of junk and other kind of credit has allowed firms to survive that otherwise wouldn't be surviving, would have shut down in the past.
So when we think about this is one of the things you and I talk a lot about, is this dynamic of very low interest rates have created the conditions that have allowed zombie firms to proliferate.
Right.
Amir Sufi just came out with a paper in the past couple of days looking at this context and basically highlighting that very low interest rates create a financing advantage for established large firms that works against the formation of new companies.
Right.
And effectively, their cost of capital is so much lower that they have a tremendous advantage versus potential new entrants.
Right.
In your mind, does something similar play out in the zombie firms where by continuing to exist, yes, they preserve jobs, right? So we get to keep the Sears employees employed.
Right.
but we're restricting the reallocation of scarce resources to other areas of the economy.
Absolutely. So it also creates a deflationary pressure by keeping that, because what you're not doing is you're keeping those assets on and those capacity on instead of rationalizing the capacity and thereby clearing out the deadwood, right?